What if I told you the future of investing isn't just about quarterly dividends, or even monthly? What if it's about daily income? Getting paid every single day just for holding an investment. Sounds crazy, right? Well, it might not be for much longer. The investing world is moving fast, and some breaking news just dropped that's bringing us one step closer to making daily dividend income a reality. Stick around. You're going to want to hear this. Recently, it was revealed that 3 brand new high-yield exchange-traded funds, ETFs, are preparing to launch. And the exciting part? They won't just be paying dividends once a month or even once a week. These new ETFs are set up to pay dividends twice a week. This isn't just rumor. The details are already filed with the SEC, and you can find all the info in the EDGAR database website if you're curious. The company behind this new wave of funds is planning for twice-weekly payments to investors. Now, these funds haven't launched yet, so those payments are still on the horizon. But with all the info in the SEC filings, investors already have a pretty good idea of what to expect. Let's take a closer look at what these funds are, what strategies they'll use, what kind of yields might be on the table, and, most importantly, whether they're worth a spot in your portfolio. Let's be honest, the idea of getting paid twice a week is pretty exciting. For a long time, dividends were mostly something investors collected quarterly or maybe monthly. But things have evolved over the years. For example, the first monthly paying dividend stock, Realty Income, started offering monthly payouts way back 56 years ago. And it's still going strong today, continuing to raise dividends year after year. Then in 2020, the first weekly dividend-paying ETFs launched. These early trailblazers came from SoFi, trading under the tickers TGIF and WKLY. Unfortunately, these first weekly funds didn't really catch on. The yields weren't all that impressive, and they didn't attract much interest. In the end, those funds were delisted because of low demand. But the idea of getting more frequent dividends didn't disappear. About 15 months ago, the company Roundhill launched 2 new weekly dividend ETFs, QDTE and XDTE. These funds used synthetic options strategies and focused on the NASDAQ 100 and S&P 500 indexes. This time, the concept really took off. Investors jumped on board, and these funds quickly attracted hundreds of millions of dollars. Their success caught the attention of other ETF providers, like Defiance and YieldMax, who soon started updating their own funds to move from monthly to weekly dividend payments. And now, the next evolution is coming: funds that pay dividends twice a week. When those first weekly dividend ETFs hit the market, some investors joked that daily dividend payments were probably next. Honestly, we might not be that far off. At this rate, we could soon see funds paying out 3 times a week, maybe on Mondays, Wednesdays, and Fridays. For now, though, we know that twice-weekly dividends are definitely on the way. And thanks to the SEC filings, we already know quite a bit about how these funds will work. The company behind these new twice-a-week dividend funds? It's Defiance, which already has experience in the high-income ETF space. Here's what we know so far. Based on documents filed on May 23rd, 3 new ETFs are being prepared. Defiance. NASDAQ 100 Lightning Spread. Income ETF, ticker QLDY Defiance, S&P 500 Lightning Spread. Income ETF, ticker SSY Defiance Russell. 2000 Lightning Spread Income ETF, ticker JR. If you're concerned about your financial security and are thinking about investing, check out the first link It's the platform I use, Interactive Brokers. Click the link to learn more. All 3 funds will follow the same strategy and payout approach, and each one will focus on one of the big U.S. market indexes, NASDAQ 100, S&P 500, or Russell 2000. So what's this lightning spread all about? It looks like Defiance is trying to turn lightning spread into a brand for this new type of ETF. The primary goal of these funds is to generate regular income for investors, with long-term growth as a secondary goal. The expected expense ratio is 1.4%. That's a bit on the higher side, but still roughly in line with what you'd see from similar funds in this category. These ETFs will be actively managed and aim to generate income daily, which is how they'll be able to pay dividends twice a week. The funds will also maintain exposure to their target indexes, using a combination of index options and ETFs that track those indexes. Any leftover cash will be parked in short-term U.S. Treasury securities or money market funds to earn a little extra income. Now let's talk about the actual strategy. The lightning spread strategy which Defiance even went ahead and trademarked, works like this. The fund buys long-dated, deep-in-the-money call options on the target index. These options act like a synthetic version of holding the index itself. At the same time, the fund writes, sells, put spreads that expire at the end of the same trading day. That's the 0 DTE, or 0 days to expiration part. The deep-in-the-money calls give the fund exposure to index gains, and the daily put spreads generate income every single trading day. The strategy aims to create a flow of income that can support those twice-a-week dividend payments. So what can investors expect when these new funds hit the market? Odds are, they'll behave a lot like Roundhill's QDTE and XDTE, which already use a similar synthetic strategy. The appeal is obvious. Very high dividend yields. In fact, QDTE currently sports a yield of more than 20%. Sounds great, right? But it's important to understand the risks. These types of funds can be very volatile and are known for big price swings. They also tend to struggle when it comes to recovering their share prices after market downturns. For example, if you compare QDE to more traditional covered call ETFs like NEOS QQQI or Global X QYLD, you'll see that QQQI and QYLD tend to recover their share prices much more effectively after market dips. QDTE, on the other hand, usually lags behind. So if Defiance's new ETFs don't manage things differently, they might see similar struggles with price recovery. That said, the big dividend payouts do help offset some of that downside, at least when you look at total return, price plus dividends. If you reinvest the dividends, QDTE has actually been beating QYLD so far this year, though it still trails behind QQQI. Whether Defiance's lightning spread approach will bring anything new to the table remains to be seen. At the end of the day, it's really up to each individual investor. Are these new ETFs worth considering for your portfolio? Or are they just too risky to bother with? Either way, it's an exciting development in the world of income investing. The evolution from monthly to weekly and now twice-a-week dividends shows how fast this space is changing. If you're someone who loves building a portfolio with strong, steady income, it's definitely worth keeping an eye on these new funds when they launch. And of course, if you want to keep up with how these ETFs perform once they hit the market, or if you want ideas for building your own income-focused like Interactive Brokers, can provide access to a wide range of investment opportunities, allowing individuals to participate in the market and potentially build wealth over time. Click the first link in the description to learn more. Want to learn more about investing? Like this video and subscribe to our YouTube channel for regular tips, tricks, and insights.